back to the Options Academy. But now that you have a better understanding of the potential profits the strategy offers, let's examine its risk profile in the case of a bullish trend. The most crucial aspect to bear in mind when trading any ratio spread is that we are essentially selling naked options, and naked options means taking on unlimited risk. Once we acknowledge the unlimited risk that is inherent in naked options, it is important to note that the ratio spread does offer better protection than a simple naked option due to the long option that is owned closer to the money. With that said, let's examine our specific structure and see how this risk profile comes into play under a bullish scenario. As with any other trade, we first look at our break-even point. Without knowing where your break-even point is, you will not be able to manage it effectively. Or as the saying goes, if you don't know where you are going, you might end up somewhere else. It is important to note that these calculations can only be based on values at the expiration date. Prior to expiry, it is virtually impossible to use any absolute numbers. It is reasonable to assume, however, that in the case of a strong bullish move, this structure will perform under more pressure, worse prior to expiration because of the volatility and time value of the two short calls. Calculating the break-even point at expiration is simple. All we have to do is figure is the value of the two short options and compare it to the value of the single long option you own and the credit you collected. If for just a moment you would put aside the credit you collected, you will see that the break-even point of this ratio at expiration is 19.5. Here is it illustrated. The one long 18.5 call expires with an intrinsic value of 100 cents. The two short 19 calls expire with an intrinsic value of 50 cents. Total value of the ratio spread, 0. Above the strike price, again, without considering any premium that was collected or any fees paid, the trade would be a losing one. Let's test this claim and examine expiration at the 19.75 levels. The trade would yield the following results. The one long 18.5 call expires with an intrinsic value of 125 cents. The two short 19 calls expire with intrinsic value of 75 cents. Total value of the ratio spread, 25 cents. Now that you have a better understanding, hopefully, of how we determine our break-even point, let's throw the premium we collected at inception into the mix. If the mix gets too sticky for you, you can try either adding flour or calling us with your questions. Adding the premium collected at inception, you can now recalculate the break-even point. In our case study, that point is approximately 19.83. At that level, the trade looks like this. The one long 18.5 call expires with an intrinsic value of 133 cents. Credit collected at inception, 34 cents. Combined value of credit and long option, 167 cents. The two short 19 calls expire with an intrinsic value of 83 cents each, or a total of 166 cents. Total value of the ratio spread, 1 cent. For all intents and purposes, we can call the 19.83 the break-even point for our structure, excluding any fees. Above this point, this specific 1 times 2 ratio spread will become a losing one. Any point lower than this translates to profit, again excluding fees. Let's move on and look into yet another ratio spread. Here, when we are buying one of the 18.5 calls, we are going to sell not 2 but 3 of the 19 calls. The first thing that is immediately evident is that the credit we collect is significantly higher. Rather than collecting 34 cents of credit, we are now collecting 86 cents or $4,300. This means that at expiration, and where the silver market is below 19, your profits are that much higher. The next thing you would notice is that now you are essentially naked 2 calls rather than only 1 call. This has 3 adverse effects on your trading. Your risk on the trade is higher, your maintenance requirement is higher, and your staying power is lower. Your break-even point on the trade, in the case of a bullish market, is now lower and closer to the money. Our prior ratio spread, the 1 times 2 ratio, has its break-even point at approximately 19.83. That point was determined by combining the credit collected at inception and the value of the long 18.5 call at expiration and comparing it to the value of the 2 short 19 calls at expiration. To find out our break-even point on this new 1.3 ratio spread, we simply have to go through the same exercise. We need to find out how much credit was collected at the inception of the trade and combine that number with the value of the call option we own. Once we figure out the numbers, we simply see how far above the 3 short options we can go until we reach the break-even point. Let's take a look. Bought one 18.5 call, paid 70 cents. Sold 3 19.0 calls, collected 156 cents. Total credit collected, 86 cents or $4,300 excluding any fees. Identifying the break-even point is achieved then by combining the credit with the value of the long 18.5 call at hypothetical points above the 3 short 19 silver calls until a break-even point is found. In our specific example, that point is approximately 19.68. At the 19.68 level and at expiration, our trade would look like this. The long 18.5 call settles with an intrinsic value of 118 cents. Credit collected at inception, 86 cents. Combined value of credit collected and the 18.5 call is 204 cents. At the 19.6 level, the total value of the 3 19 calls is 204 cents. When deducing the total value of the 3 short calls from the combined value of the long call and the initial credit collected, we arrive at break even. Therefore, for all intents and purposes, we determine the 19.68 to be our break-even point at expiration, excluding any fees. Above this point of expiration, the trade will become a losing trade. Let's take a quick glance at the scenario in which at expiration the market is at 20 level. The long 18.5 call settles with an intrinsic value of 150 cents. Credit collected at inception, 86 cents. Combined value of credit collected in the 18.5 call is 236 cents. At the 20 level, the total value of the 3 19 calls is 300 cents. Total value of the ratio spread at expiration is minus 64 cents. Total loss in dollars, 64 times $50 equals $3,200 excluding fees. Therefore, remember that every additional option you sell in a ratio spread increases your risk significantly. With that said, it is also worthwhile to take a look at the profit potential of this new trade. The profit profile peaks at expiration when the market trades just below the 19 calls we sold. For the purpose of this example, putting aside practical trading, we will use the 19 market level as our point of expiration. At expiration and with the market at 19 level, our ratio spread would look like this. The long 18.5 call settles in with an intrinsic value of 50 cents. Credit collected at inception, 86 cents. Combined value of credit collected and the 18.5 call is 136 cents. At the 19 level, the 3 19 calls expire worthless with a total value of 0. Total value of the ratio spread at expiration is 136 cents. Total value in dollars, 136 times $50 equals $6,800 excluding fees. Under this scenario, which might be ideal or somewhat unlikely, but possible nonetheless, the profit on this trade would reach a staggering $6,800. 136 times $50 equals $6,800, excluding fees, on one single structure. With such potential results, it is no wonder traders are attracted to the strategy. It's time to bring this article to conclusion. As we mentioned at the opening of the article, a ratio spread describes any strategy in which different numbers of options are bought and sold. We have described 2 examples of such ratio spreads: a 1-by-2 ratio spread in which we bought 1 option and sold 2 options, and a 1-by-3 ratio spread in which we bought 1 option and sold 3 options. Following the same guidelines, the profit potential and risk, you could examine a 1-by-4, 1-by-5, 2-by-8, and virtually any structure you wish to create. Here is to your success. And remember, there is substantial risk of loss in trading futures options. Remember that past performance is not necessarily indicative of future results, and remember that only risk capital should be used. We hope to see you soon.